In today's video, we're zooming out to look at something most people would never expect: Zimbabwe. Yes, Zimbabwe. A country that once experienced some of the worst hyperinflation in modern history is now reporting annual inflation of just 4.1% as of January 2026. Think about that for a moment. By the end of this video, you'll understand what changed, what the new gold-backed ZiG currency actually is, and why this could be a powerful real-world example of how gold anchoring affects inflation. For the first time since 1997, Zimbabwe has recorded single-digit inflation. That's almost 3 decades. And this shift didn't happen randomly. It coincides with tighter fiscal discipline, more controlled money supply growth, exchange rate stabilization, and the introduction of the Zimbabwe Gold currency, the ZiG, in April 2024. So the big question is gold the difference, or is it the discipline behind it? Let's unpack this slowly. In January 2026, inflation dropped to 4.1%, down sharply from 15% in December 2025. That's not a small move, that's structural. Authorities limited liquidity growth, reduced direct government financing from the central bank, increased foreign reserve backing to over $1.2 billion, and stabilized exchange volatility. When price expectations calm down, businesses stop panic-adjusting prices, and that alone changes the psychology of an economy. Let that sink in. Now here's where it gets interesting. The ZiG is backed by gold reserves and foreign assets. That means it isn't purely fiat. It has a nominal anchor tied to something scarce and tangible. Historically, when money is tied to gold, expansion becomes constrained. You can't just print endlessly without consequences. And when expansion is constrained, inflation pressure tends to fall. That's the theory. But does history support it? If we zoom back to the classical gold standard from the late 1800s to World War I, most major economies fixed their currencies to a specific weight of gold. Over long periods, price levels were remarkably stable compared to later fiat eras. Was it perfect? No. But long-term inflation was lower and more predictable. When convertibility is credible and enforced, governments have less incentive to overexpand money supply. That's powerful. Even under systems like the Bretton Woods era, where currencies were indirectly linked to gold through the US dollar, inflation volatility was generally lower than under fully unconstrained fiat systems. That doesn't mean gold solves everything. In downturns, gold-linked systems can create deflationary pressure. But what they do very effectively is impose discipline. And discipline is often what fiat systems struggle with. So Zimbabwe's ZiG becomes fascinating because it's a modern digital version of a gold-linked currency. It combines physical gold reserves, foreign exchange backing, digital traceability, and policy integration into a broader macroeconomic plan. It's not a return to the 19th century. It's a hybrid system. And so far, inflation data suggests something is working. The question is it gold itself, or the credibility built around it? Before we go deeper, thank you for being here and for supporting the channel. If this breakdown helps you see monetary systems differently, consider liking and sharing. It really helps more people understand what's actually happening behind the headlines. Now let's talk about trust. Zimbabwe went through devastating hyperinflation in the 2000s. Confidence in the currency collapsed. When trust is gone, inflation becomes self-fulfilling. So anchoring the ZiG to gold reserves isn't just about economics. It's about rebuilding psychological confidence. Gold represents scarcity, permanence, and historical store of value. When people believe money will retain purchasing power, behavior changes. Wow. There are also discussions around historical instruments like the 2008 billion special agro checks and the 100 trillion notes issued during the crisis period. Some narratives claim these are backed by gold reserves or historical gold holdings and could be connected to digital gold certificates or blockchain traceability systems. But they are part of the broader conversation around asset backing and redemption frameworks. The idea behind isolated blockchain settlement systems is to move value outside traditional centralized financial rails. In theory, such systems could create transparent, traceable movement of asset-backed value. Whether Zimbabwe's ZiG evolves into something larger or whether it remains a domestic stabilization tool remains to be seen. But what we are witnessing is a real-world test of commodity-linked monetary anchoring in the 21st century. So here's the bigger picture. Zimbabwe's drop to 4.1% inflation shows that strict monetary control combined with asset backing can stabilize expectations. But gold alone is not magic. Discipline, credibility, reserves, and policy execution matter just as much. If those collapse, no anchor holds. Think about that. As Zimbabwe experiments with this gold-linked framework, the global lesson becomes clear. When money is aligned with tangible assets and constrained supply, inflation tends to moderate, provided governance supports it. Whether other nations follow or not, this case gives us something rare, a live experiment in monetary anchoring in the digital age. Thank you for watching and for your support. These shifts may look small on the surface, but they touch the foundation of how money holds value. See you again very soon.